You got to work that fear muscle, and that's what it is, that risk and fear muscle, and start small. That's why the house hack is great, because you can't get yourself into too much trouble. If you figure out that your mortgage payment is $3,000 a month, and everything rented out is 4,000, just keep those people happy, keep it rented. It's just, that's the great thing about house hacking. It gets you started, and then once you do it, and I was like terrified for the first like few months, and then when I had to rent to someone and show apartment, it's terrifying. And then 2 years later, I remember talking to my friend. I was like, this is like the best thing ever. This is like 2008. I was like, this is it. This is how you make money. Like, I figured it all out after 2 years, like the right way to go about it, what I made a mistake. And that's not the way you will be too. And, you can then figure out, but really knowing your goals, I think, is the best way. And that'll help you alleviate a lot of the fear, because you'll have kind of a plan of where you're going and how you're going to get there.
Hey, what's up, Masters? Welcome to another episode of Path to Mastery podcast. Today, we're with Mr. Charles Carillo. How are you today, sir?
I'm doing great. Thank you so much for having me on, David.
Absolutely, man. This is one of my favorite conversations, brother. I'll tell you, I've been a real estate agent for 23 years, or the 17 of the last 23 years of my life. And actually, it's been longer than that. Crap, what did I say? Yeah, it's been like 20 of the last 23. And I always say, if I would have gone back and did it over again, instead of selling so many homes, I would have invested or bought a lot more real estate. Instead of helping other people buy it, I would have bought it. I think it's like one of those things. But you can never go backwards, right? Unfortunately, no. You just learn and keep moving forward, man. So thanks for joining us today again.
Yeah, no, it's awesome to be here.
How did you get started in the investing space?
So I'm originally from a small town in Connecticut, and my dad has been a multifamily investor since 1984. And so several months after myself being born. So I grew up in the business in elementary school and middle school. My dad invested in less than ideal properties, let's say Class D and Class C properties, in a little tougher of a city near where we lived. And he built it up with a partner to about 100 units, and they started selling it off in the late 90s. But that was a whole education for me. Education that I wanted to invest in better properties. And I really didn't want any part of it until I got into high school, and you really see, a lot of the pros that come with investing into real estate, which is we get a lot of cash flow. Not that you don't have to do anything, but it's nice to, especially if you're self-employed, know that, when Monday comes around, you're not scrambling for the rest of the week. You've got, you've got something that's coming in, and you have to work a little bit for it. I mean, obviously it's not all real estate's not a passive thing. It's a semi-passive investment at best, but it's nice to have that recurring revenue and be in a business like that. So those are the things I saw. And then when I got out of college, I started in 2006. I house hacked my first property, and what that, back then we didn't have a term for it like that, but it was buying a 3-family house, which we have a ton of them in the Northeast. And I lived in one of them, and I rented out the other two, about 1.5 miles from where I went to college. And that was a great experience. And when I got it rented fully and everybody paid rent on time, I think my cost of like expenses and stuff was like $40 a month. So it was pretty nice. And then I threw an extra few $100 into the checking account to make sure when something went wrong, because it always does. And got a little over my head with that one. That was a lot of renovation on that I shouldn't have been doing. But a couple years later, in the end of 2008, all these great times when I choose to invest, right? End of 2006, end of 2008, and it was a bloodbath out there after Lehman and before Madoff came out. Just like the end of 2008, every time you turn on TV, something failed. And I bought another 3-family, which was pretty much my best investment I ever made up to that point, or for years after that as well. It was just a great property, and I had really long-term tenants in that. And then my next year in 2009, I bought my first commercial property. And so kind of went from there. And that was a one office with 4 apartments above it, what we call like a mixed-use property, which you'll see in any kind of city center. And that started me into multifamily, into commercial multifamily stuff. And I self-managed all those properties 2006 to 2012. I moved to Florida in 2012. I put some professional management in front of them to run those. And I sold that whole portfolio to an investor out of New York in 2022. But since 2018, 2017, being down in Florida, we've purchased larger properties and started syndicating investments, which means, we take money and we work with passive investors to buy larger apartment buildings here in the Southeast, usually better properties, B-class properties, 100+ units.
How many units do you guys have?
Right now, we are just under 1,000. We
Okay.
sold 5 yeah, we sold 5 properties in the last year and a half,
Okay.
mostly in 2022.
All right. Perfect. One thing you said that I have to go back to is, I remember when I first got my real estate license, I didn't know it was called house hacking. Now that I know that, I tell everybody to do that. It's as a matter of fact, somebody I know right now, unfortunately, he's going through a divorce, and he's like, I'm not sure what I should do. And I says, well, just go buy a 3-family, live in it, rent out the other 2 units, and then figure it out as you're doing that. And then, but anyway, a friend of mine bought. That's what he did. He went and he bought a 4-unit,
Mhm.
and I bought a single family house. My friend and we did it at the same time. We had bought 30, 25 years ago or so, and when I ended up selling that house, I made, I don't know, I made like $90,000 or something. He sold that 4-family and made almost $600,000
Wow.
and lived for pretty much free. I mean, actually he lived for free. He was making
Yeah,
money. Never mind, lived for free. He was putting money in his pocket
yeah.
pretty much the whole time. So yeah. Anyway, that's a lesson. I want to go back to something else you said though. You said semi-passive, at best, not passive. What do you mean by that?
So when I own my own properties and when I self-manage them, it's an active job. It was like, you know what I mean? Not like you're going there every day or anything like this. I live like within a half mile with my office there, and all my properties were all within a half mile of each other. I strategically like got them all set up like that. So it was very close and easy to manage. But that at that point when I was actively managing, it was definitely it was a job. And then when I put management in place of it, it turned into a semi-passive investment because my day to day, no one's calling me if a toilet needs to be plunged and all that stuff, which I did on Christmas Eves before and all that stuff. I got a number of those calls, but when you had the property manager, they're taking care of that, but they're still bringing you in for larger things. Hey, it's sometime we're going to need to change this roof, has to be done. Probably want to start talking to people about these porches should start getting painted. You want to talk to find a contractor for that. And so you have these things that kind of require your attention, and you need to be proactive with them. And that's why I would say it's semi passive, because I might not hear from that property manager for 3 weeks, but then you hear from it. And now I've got 5 hours one week I'm spending making calls, sending emails, making sure that contractors are at properties and stuff like that.
So there is involvement.
Yeah.
There is some, but isn't there a point where you come to a level where it is passive though? If you hire a property management company and you have somebody managing, I mean, you can get to that level, can't you?
Yeah, you can. I mean, I only had, I had less than like 20 units, you know what I mean? From the stuff that had with my property manager. So you do get it to a level, but it's still what we call is like you're being like the asset manager. You know what I mean? So you're not the day to day there. You're still taking, I'm not taking calls from tenants. I'm not, talking to tenants or anything like this. So like a lot of that very time sensitive stuff is off your plate, which is great. But the thing is that there's certain things that still need to be done that you have to get the okay on. So if, hey, this is $1,000, do you want to do this? Do you want to find someone else to fix this? Hey, a tree went down the backyard. I'm going to call my guys. Going to charge you 1,500. Do you have someone else up there? Call them and then send them by our office to get paid. So you can do all different ways of doing it. If we were large enough, if I had like 50 or 100 units myself, what I would have done is hire someone full time. And then my property manager would have paid them, and that would have taken care of the majority of those issues. But still, there's still things. I mean, you still have insurance policies. You know what I mean? I would still want to check every month and make sure that, we're getting collections coming in on time. And this all takes time. I mean,
Sure.
so it's not like fully passive. When you start getting into where we are on like the passive syndicating stuff and where we're bringing on passive investors, that's a much more passive and
Yeah.
passive type of way of doing it, where maybe an hour a year you're spending between getting tax documents, between reading reports coming back or updates from the operator. So when I passively invest, after you invest, I really probably spend like an hour a year on that. But on deals that we're doing, it's much more active because they're larger, and I'm on weekly calls with property managers and stuff like that. But that's what we do.
Got it. Okay, cool. Yeah, I'm an investor. I say an owner, but I am an owner, I guess, because I invested a chunk in it. But the only thing I did was I invested the money,
Mhm.
and I get a check every month, and that's it. I don't deal with anything
Yep.
else. It's a property management company. It's done through a portal,
Mhm.
and that's my involvement is receiving a payment every month, which to me that's passive, right?
Yep. Yeah, that's the most
You
passive you're
know,
really going to get in real estate is to be in a syndication or something where you're investing and someone else is handling everything, everything.
yeah, I sold a two family I had to do that, as a matter of fact. Way better. Actually the two family was a frigging nightmare all the time. Tenants, people come, go, you got to deal with, call, just like everything you said, the calls, oh my gosh, my basement's got water in, just this. And then I wasn't making a lot of money. And so I took the money and I invested in, now I make a little bit less money, but there's no headaches. Like
Yeah.
it's nothing. I love it. I love it. And I don't have to pay property taxes. I don't have to deal with any of that stuff. You know what I mean? Or insurance. But anyway, I'm going on a tangent. Sorry about that, my man. So let me ask you this: why don't more people do this? So there's two questions. Why? First off, why aren't more people doing this? And then I've got a follow up question to that.
Like investing in real estate passively or
Yeah,
actively.
yeah.
I mean,
So yeah, to go back to the point, like the
yeah.
fear of investing, what holds
Mhm.
people back from investing?
I think people don't understand exactly. They don't have a knowledge of real estate to an extent where they feel comfortable with it. Real estate's still considered a alternative investment, which is weird, but it is. And stocks and bonds and all this mutual funds are considered more of a traditional investment because you can do them right through your 401k without any issues, and everything's designed for that. So I feel when you start getting into alternative investing in real estate, for example, that's something where people just there's not much knowledge on it. It's not something that's taught in class. It's not taught in any type of college class. It's all type of information that you're not going to learn. If you're at a job, you're not going to learn it from anybody that's running your 401k because they're not going to make any money off that. So it's something that knowledge that you have to find, search out, and have to educate yourself with. So I think that's number one. I think most people know that real estate's a good investment. I mean, you just spoke to me about it's the same conversation you have whenever you talk about real estate investing. Someone says they made a bunch of money one time in real estate. They had a friend that made money in real. Everybody knows someone that made money in real estate. So they know it's there. They just don't know how to do it. And everybody's scared about getting the call at midnight, you know what I mean, for the toilet. And so, I mean, that happens when you actively invest, but there's ways you don't have to do that.
Mm. Yeah, I'll never go to a toilet in the middle of the night. What's you mentioned syndication earlier as well. What's tell our listeners about a syndication?
Yeah, syndication in 60 seconds or less is really a syndication is there's two groups of people. You have managing partners, also known, well, they're general partners. They're what we call the operators, syndicators, sponsors, whatever you want to call them. They are running the deal actively. They're doing everything from finding the market, finding the property, buying it, putting money together, dealing with the property manager, and then ultimately refinancing it or selling it. And then you have another group of people, which is the passive investors, also known as limited partners. And all they are doing is just what David did is they're reviewing it and providing capital, and that's it. They should be getting a monthly report from their sponsor, from the operating, from the general partners about what is happening at the property, but their involvement is nothing after they've made that investment. And then typically what happens after a few months or a couple quarters of being in that investment, they should be getting some sort of quarterly distribution or monthly distribution after that property is back on the upswing, because you're buying properties that need a little work to get them more profitable. So in the interim, you might not make as much money, but after it, you should be getting something that's 6 to 8% we would hope for on a split up in a quarterly.
Yeah, that's exactly right. Do you have a, like, for you, for people listening, what would you say if someone's like, well, I'm thinking about investing? Would you tell them to go that direction, or is there a different direction? Like what
I
do you
Yeah, it depends.
how does somebody determine that?
What do you really want to do? I would see, like, what is your real goal? Like for you, you don't want to be a landlord. You don't want to learn anything about active investing. You did that. So for you, passive investing is best for you. You have a business that you get paid well at. You trading time for $35 tasks or something like this an hour doesn't make sense for you. Just like any type of professional or person that has a successful business, I would suggest them more to go on the passive side. If you are a new investor, you're a young person, and you want to be active in the business, like you said initially, maybe house hack your first deal, buy that 2 to 4 unit property, use that FHA mortgage, get the great financing, do it, become a landlord overnight with only 2 or 3 other tenants. So it's not like overwhelming. And that'd be a great way of getting starting out. But if you don't want to be active, go the passive route. Because if you just want to have that diversification of your portfolio, the passive route's the best. If you really want to become an active real estate investor, I would start with the house hacking. If you have more money and stuff like this, maybe you purchase a larger complex, 12, 18 units, get a property manager to run it. And now you're an active investor, but now you have a manager that's taking care of those really tedious day-to-day tasks.
Mm. Well, we have a couple people with us here on YouTube live, which is great. So feel free to drop a chat or a question if you want in the chat. Drop a chat, drop a question, and drop a chat. There you go. Drop a message in the chat or a question. And we also have a group of people on Clubhouse. We're streaming live on Clubhouse. Looks like we got about 25 people on Clubhouse. So by the way, if you have any questions on Clubhouse, what I like to do is open it up to questions live on Clubhouse. So if you do have a question for Charles, raise your hand and I will bring you up, and then you'll get to ask Charles a question, and you'll be live on the podcast with us as well on Path to Mastery. So feel free to raise your hands if you guys have any questions, and feel free to drop your comments in the chat or the comments. All right. So what would you say, Charles, is the biggest mistake you see people making when they're trying to get into the investing space?
If the biggest mistakes, or the way I guess you would say to limit your downside when you're investing initially into real estate, is number one, I would make sure that when you buy better properties, so you want to be buying properties that are in good areas, those are the ones that are going to appreciate in value. Those are going to be easier to manage. You're going to get better tenants in there. Next is what I would say is get long-term fixed debt. Don't go and get variable rate loans that are going to need to be refinanced with interest rates going up or going sideways. You don't know what's going to happen in a few years. Don't deal with any of that.
What do you consider long-term? Because I know like we did a 5-year loan on a project we did. Is that considered that's probably short-term, right?
I would say 5 to 10 years is, if you're doing commercial properties, you're not going to be able to, for the most part. I've done it before, but most banks aren't going to give you like a 25-year term loan, right? So I would say at least 5 years. 5 years gives you a window. It gives you a lot of time. I mean, it's only 5 years. I understand that, but it gives you a lot of time to go through any type of, at that time, you can renovate the property, you can get it working correctly, you can increase value on it. And then when you go back to the bank for them to give you, you can show that you've made value in it. I'm saying, don't do like some sort of floating date debt that's like got a 2-year term on it or anything like that. Because 2 years, you don't know. 5 years, 7 years, 10 years. I would really push for 10 years if it's your first investment. The longer the better. And you're going to pay a little bit more in interest rates for that, right? But that protection allows you that, okay, my debt payment's not going to change for 5 years, 7 years, 10 years. That's a great thing with house hacking or anything like that. You can go 30 years on it. So now I know exactly what my principal and interest is going to be for the next 30 years. The only changes in this large payment are going to be my insurance and tax for the most part. And then your maintenance, obviously, that's with any type of thing. But the most of your expenses, your outflows are going to be kind of cap fixed. And you'll know about that. And then the last thing I would say is have a reserve. A lot of people, when they're going to a property, they go, oh, I need $50,000 to buy this property. Well, you need a lot more than that. If you're doing any renovations to it, you need that money. And then you're going to also add in, you should have a reserve of like at least 6 months of expenses. So if something happens, you're able to weather that, especially with smaller properties where, like you said, with the 2-family, where someone moves out, you're not going to cash flow unless you bought it for like nothing. You know what I mean?
Yeah.
But in most situations, you need all those people in there paying. And if there's any type of disruption, you're not cash flowing. That's why having more units, buying properties with more units, or passively investing in deals that have many units. That way it's less volatile and it's a more consistent income stream. And, you can cover a lot of repairs and maintenance by the people in there paying rent.
So you gave us, number one, good area. Number two is the debt, right? Long-term. What was number three? I apologize. I may have,
having a reserve.
Reserve. Sorry. Okay. Got it. Okay. Just want to make sure. So those, and is there a 4? So
those are the top 3, I would say. I mean, if we got more into it, I would say, when you're buying into an area, just make sure you're buying into a growing market. You know what I mean? A market where there's population growth, job growth. That job growth is like
and that goes with number 1.
Yeah. It's all put together, but those are the main things. If you work off those 3 things and the property is cash flowing as you buy it, it's going to be very difficult to lose money unless you just run it into the ground. But I mean, that will really limit your downside.
I love it. All right, good. So area, I mean, critical, right? Real estate, location, debt, and then reserves. So I studied under Grant Cardone for a while, and he says, don't buy anything less than 32 units. What is your philosophy on that?
That's fine. If you are that person that I said before that has money, wants to be an active investor, or you're you're a dentist and you two other dentist friends want to buy a property together. We sold a property last year that went to a group of dentists that bought it. And that's fine. Put your money together with them, have property management, you can do it, and it'll be fine. However, when you're looking at that, say those units are, $100,000, $150,000 a unit. I mean, that means that that group of people are going to come to for 32 units. I mean, with all their down payment, closing costs, reserves, the whole 9 yards, it's like $1 million they're going to need to purchase that property, with renovations, let's say, or any updates they're doing. So that's quite a check. I mean, if you're trying to get in there, the government's given us this great FHA mortgage, and it allows you to get in with like a 3.5% down. And utilize that. That's a way of like dipping your toe in and utilizing this great thing that government's giving you, where you have a very low down payment, the lowest down payment you're ever going to make, with a loan, and you're able to become a landlord. And the good thing, pros and cons. If you're a younger person, for me, I didn't have a problem living next door. It was like above and below apartments, to my tenants, right? It wasn't really a problem for me. Some people might not like that, and that might not be the thing for you. But especially when you're working and you're home, there's an issue, something like this. I don't have to drive anywhere. I'm on site. So if there's a problem, right, you can stabilize it before you call your handyman or whatever it is to do it. And it allows you to, be a part-time, landlord, and figure out how it is. And maybe you hate it, you sell it. And maybe you move out, you just rent out your unit and buy another house and move out. And so that's what I would say.
I think that's the best way. I think for everybody listening, if you don't own real estate yet, I think that's the best way to get started. You use an FHA loan, right? Or you don't even need an FHA loan. You can just get a conventional loan,
Yep.
whatever, buy a multi, move in one unit, right? Then once you decide to buy a single family, you rent that out. Now you get 3 units.
Right. Exactly.
Right? And I do like the FHA though, only because it's 3% down, right? That's why you said that.
Yeah, it makes it easier. You can go to a credit union or a bank and get 5% down. I mean, you can get 0% down. There's all these different programs. I'm just saying that it's a program that's going to be a little easier to get you approved as a first-time investor. Maybe you're coming out of college, you got some debt, stuff like this. It's a great way to start. And do it before you get yourself sold out. I remember I moved out one of my properties, like a 3-family that I was house hacking, maybe in like 2010, 2011, and I didn't have to sell the property. I literally just put someone else in that property, a new person in there, and I could have held it on to, a better price in the market.
I just can't believe I'm 23 years in real estate and I've never heard I didn't know what house hacking meant until just now. I find that crazy. Anyway, good. Now I love it though. All right. What else? Mitigate risk. How, I think we talked a little bit about that, but anything else you want to add when you come to mitigating risk?
It's really going back to the reserve, having the debt, and then having the area. And the area allows you to, it's easier to manage the property, but also it's going to allow you to easily sell the property. It's much easier to sell better properties. There's always buyers of good properties. I mean, you've been in real estate for many years. If you're selling something that's not in a great area, it's harder to sell. There's always going to be people looking to buy good areas properties, and maybe not at the top of the price if it came down a little bit, top of the market, whatever it might be, but they're going to still pay you very well for a property in a good area. And it won't decrease as fast as a poor area will.
And I'm looking at one of the questions you sent me. How do you decide which sponsors? What's a sponsor?
So yeah, in syndication, there's, we call it general partners. They'll be called sponsors or operators, or, one of many other terms, principals. And so when people are passively investing, you have to find one of these groups to passively invest with. And you're going to find a bunch of them, and you're going to have to vet them some way. So that's one thing that sometimes I'll speak about how, because I passively invest as well into people's real estate projects, into other asset classes as well through syndications. So it's one thing that you have to kind of vet them and understand, make sure you're on the same page and that they're going to be a good steward of your money.
I love it. All right. And what about the markets? Like, how do you I know you said good area, but how do you decide what areas to focus on and what properties, et cetera?
So when we're looking at a market overall, and you're going to look at, I want to see an area where over the last 20 years, we're going to see an increase in population that's consistently grown over that time. I want to see a because population growth is one thing, but I want to see job growth. And then I also want to, when I check into the stats of the job growth in that area, I want to see it be diversified. I don't want to see 25% of it going to one company or going to one industry. You want to see something where it's like 5 or 7% for tourism, 5 or 7% for hospitality, whatever it is. It's like really diversified. So if there's any type of shakeup, well, that's when you know that there's, you're going to have least of issues. It's like when COVID hit hard and we looked and saw where the unemployment was, and Texas, Florida, 12.1%, something like this. Then we get to like Nevada and it's like 28, 29%, right? Goes to show you not as diverse in certain areas. Now, that's not the whole state. That's a general statement, but it's one quick thing that you can see. Hospitality is a huge portion of their economy. So that's just one thing you have to be noticeable when you go into it. Next thing is really over the last 20-year period, I want to see a decrease in crime. And decreasing crime over a long period shows that obviously they are patrolling and being police officers and everything like this, but they're also investing into healthcare, because you can lock up everybody and 2 years later you'll see it spike again. But to consistently lower crime over a long period, that means that they're actually investing into healthcare in the area and they're investing into the community. And these are things that you just can't do overnight. So that's why we always do like a 20-year period on it. And that gets you into really the market where you want to go. And then as you dig into it more, as you start getting into neighborhoods, you can pull up a number of things online, finding, income demographics of where the lines go, where the quintessential, where the railroad tracks are, and you'll know where to invest on one side versus the other, because all this stuff is available and you can look online for free at different websites, see the crime, and then that will help you narrow down into a neighborhood where you'd want to invest.
All right. Makes a ton of sense. By the way, it doesn't look like we have any questions from Clubhouse today. And for people that are listening here, if you're listening right now on iTunes or wherever you listen to your podcast, you can actually go watch this. It'll be live on. You can watch the video and see how handsome Charles is here on YouTube. Just go to David I Hill. That's my YouTube channel, David I Hill. You'll find me on YouTube and you can watch the video. And please subscribe. Don't forget to subscribe. We got to continue building that YouTube channel. Chris, Charles, I'm wondering what else I didn't ask you. Anything else I missed that I should have asked you?
No, I mean, it's just, if you're interested in real estate investing, I mean, it's a great way. There's a number of ways of getting started out there, and people look at it and they think it takes a ton of money. And yeah, as you start growing into bigger properties, there is a requirement for capital, but you can get started pretty inexpensively if that's really what you want to do. But I would really, before you start getting involved with anything, figure out what your 5, 10, 15-year goals are and kind of work back from that. If your goal in 15 years is not to be owning actively real estate, well, I wouldn't start doing it. Maybe learn about it and passively invest. If you want to be a landlord, overseeing different property managers and different properties, that's what your goal is. We'll start out in, start doing a property, managing a property, because doing it yourself, you're going to learn a lot more than any type of books or websites or blogs or podcasts. I mean, you just got to get out there and do it, make mistakes. And I mean, I've made tons of mistakes. So it's, everybody does it. And, you just got to do it sooner than later. And then you can correct yourself on the next deals.
I've got one more question, but I want to find out first. You have a podcast. You also have an investor club at Harborside Partners. What's the best way for people to tell us about your podcast, and then what's the best way for people to get in touch with you?
Yeah, so my podcast is Global Investors Podcast, and I do a weekly interview type podcast, and then also I call it Strategy Saturday, and I do a Strategy Saturday episode, which is like 5 minutes on a different term or something within real estate that people can actually learn something from quickly. And with YouTube and the whole 9 yards. And then we have a passive investing guide on our website, harborsidepartners.com, harborsidepartners.com. And I'm very active on LinkedIn. So if you're interested, Charles Carillo, you can follow me right there. And I put out a lot of different information on the economy, a lot of graphs, a lot of charts, a lot of stuff, a lot of visuals on everything around the economy and real estate.
All right, great, man. Amazing. So my final question for you today is with the topic is overcoming the fear of investing. So somebody that is dealing with that right now, what do you say to these? Like someone's like, oh yeah, everything you said, Charles, sounds great. Makes a lot of sense, but I don't know. Right. Like there's still that little bit of fear there, right? Or that lot of bit of fear there. What do you say to those people?
You just got to do it. I mean, if you got to work that fear muscle, and that's what it is, that risk and fear muscle, and start small. That's why the house hack is great, because you can't get yourself into too much trouble. I mean, if you figure out that your mortgage payment is $3,000 a month, and everything rented out is $4,000, I mean, just keep those people happy, keep it rented. I mean, it's just, that's the great thing about house hacking. It gets you started. And then once you do it, and I was like terrified for the first like few months. And then when I had to rent to someone and show apartment, it's terrifying. And then 2 years later, I remember talking to my friend. I was like, this is like the best thing ever. You know, this is like 2008. I was like, this is it. This is how you make money. Like I figured it all out after 2 years, like the right way to go about it, what I made a mistake. And that's not the way you will be too. And, you know, you can then figure out, but really knowing your goals, I think is the best way. And that'll help you alleviate a lot of the fear because you'll have kind of a plan of where you're going and how you're going to get there.
Brilliant, man. Brilliant. All right. I know I said last question before, but this really is my last question. So what would you say to everybody listening if there's one thing that you want them to do from listening to this today? What is that? What is that one thing?
I would say do your goals. I mean, figure out what your goals are and whatever you're doing, even if you're not in real estate. I mean, figure out exactly what you're trying to go at and then break that down from what you want to do or what you think you want to do in 10 or 15 years and break that down to the 10-year, 5-year, yearly, monthly, weekly, and that'll help you plan out your week. Even if you're working in a full-time job or you have a full-time business and you're trying to do like some sort of side hustle, you know, this allows you to know exactly what you're doing so you can make progress on those bite-sized pieces towards your goals.
Awesome. It's funny. Grant Cardone just popped in the clubhouse room, but then he bounced. I would have loved to hear his thoughts. Maybe someone told him what I said. All right. Well, listen, man, it's been a pleasure. I appreciate you. Great conversation. And yeah, for you guys listening, make sure you go check it out. Check out the video on YouTube and connect with Charles, man. He clearly knows his stuff. It's harborsidepartners.com. And your podcast again, one more time.
Global Investors.
Global Investors. All right, my man. Well, I appreciate you and thank you for your time today.
Thank you.